Good afternoon. This is Sean Golding with Golding & Golding, here to discuss a little bit about tax complications that occur for expats, people who are U.S. persons but live overseas. Why do expats even have to pay taxes in the first place? And what to do to fix some of the more common errors that expats make when preparing their taxes and other forms each year. So let's go through it. First things first, identifying who is a U.S. person for tax purposes. Okay, typically that's going to be U.S. citizens, whether they're born or naturalized, lawful permanent residents, foreign nationals who meet the substantial presence test. The latter category is a counting days type of test. It's typically going to be your visa holders, H-1B, L-1, EB-5, O, etc., etc. It's not just employment, in other words. You don't even have to have a visa, but if you stay in the United States for too many days, then you're considered a U.S. person for tax purposes, just as if you were a U.S. citizen or permanent resident. It means you have to report your worldwide income, report your foreign assets, and there's various techniques that taxpayers can use to try to minimize the tax implication of being a U.S. person, such as applying foreign tax credits, foreign earned income exclusion, and making a treaty election to be treated as a foreign person or non-resident for tax purposes. So that's sort of the baseline, right? If you're a U.S. person, you pay U.S. tax, you report your worldwide income. Now, a lot of taxpayers who move overseas, they're considered expats. And we're not talking about expatriates, as in people who formally renounce their U.S. citizenship or terminate their permanent resident status, but just people who, wanderlust, job opportunity, whatever it is, they're living overseas. Let's go over 5 important, common kind of expat tax complications that arise all too often. One is this worldwide income concept. So most countries have residency-based taxation for individuals, and what that means is you could have been born in that country and a citizen of that country, but unless you're living in that country for more than 6 months out of the year, that country is not going to tax you on your worldwide income, all right, because you're not a resident of that country. The United States does it differently. U.S. purposes, it's citizenship-based taxation, which is a misnomer because it's not only citizens, it's all 3 categories we just discussed. But if you fall into any of those categories, you're taxed on your worldwide income. So if you're an expat, you live overseas, all your income is foreign sourced, you work for a foreign employer, you receive foreign dividends and interest from your investments and things of that nature, you still have to report that on your U.S. tax return. One common issue we see here is gross income versus net income. So let's say you live in a foreign country, you make $400,000 a year and you pay 30% tax. So let's do some quick math, right? $120,000 in tax and you net effective $280,000. So some people will come to us and they might have gone to a tax practitioner, did it themselves, and they reported the $280,000, and their thought is, well, at least I don't have to report the $400,000. But actually, there's a much better way to do it, which is you report the full $400,000. And then on Form 1116, foreign tax credits, you also claim the tax credits that you paid. So at the end of the day, depending on what your tax rate is in the United States, you get credit for all the taxes you paid. Now, it's not always dollar for dollar. Sometimes you have excess credits and you can carry it forward. Sometimes it's exact. Congratulations, right? Sometimes it's below and then there's a gap and you have to pay the difference. But the idea is don't report the net, report the gross, and then report your foreign taxes that you paid separately. Another common issue we see is exempt income overseas. So especially in Asian countries, a lot of passive income is not going to be taxed for people who are residents of that country, dividends, capital gain, interest. The U.S. is going to tax you on that income even if it's exempt overseas. The baseline position is that the income is taxable. You may be able to claim, maybe there's something in the treaty, maybe there's a specific revenue procedure, regulation, etc. But baseline perspective is just because it's tax exempt or tax free or not taxed in a foreign country doesn't mean you can exclude it from your U.S. tax return. Another issue is reporting foreign accounts, assets, and investments. So the United States requires U.S. persons, including expats, to report assets that they have, foreign bank accounts, investment accounts, securities, mutual funds, pooled funds like ETFs or CCOVs, and life insurance and pension and all that. So in addition to having a worldwide income requirement, there's also a worldwide reporting requirement. The 2 common forms you're going to have to file is the FBAR and the Form 8938. Form 8930 is for FATCA, the Foreign Account Tax Compliance Act. Your foreign financial institution may send you a Know Your Customer letter, KYC, where they want information about you for FATCA compliance, et cetera, et cetera. But those are the two main forms. Something to keep in mind, the threshold requirements for filing for FATCA Form 8938 when you live overseas is much higher than if you live in the U.S. So if you lived in the U.S. and maybe you had these foreign accounts and you did report them when you move overseas, the threshold is higher. You may not have to report it anymore. And one other thing to keep in mind is the additional type of reporting that can get very complicated. There's foreign trust reporting, foreign entities, and PFICs. Out of all the different types of reporting, these three are the most complicated. Some of the other international reporting forms you'll find is Form 3520, 3520A for trusts, 5471 for foreign corporations, 8865 for foreign partnerships, and 8621 for PFIC. Excuse me. PFIC is like foreign mutual funds, other foreign holding companies that generate passive income. So expats living overseas, they learn about these ridiculous rules and what can they do to avoid it. So let's go through some of the things someone can do to either minimize or reduce their taxes. One is the foreign tax credits like we discussed. There's also something called the foreign earned income exclusion. If it's earned income living overseas, taxpayers can exclude upwards of like $120,000 to $130,000 of earned income along with some housing expenses. Very important. If this was a 6 list instead of a 5 list, I would have included this as well. You have to include the income on your tax return and then exclude it using Form 2555. You don't go, oh, I made $110,000, so I don't have to file anything. It doesn't work that way. How would the IRS know? And especially with the IRS these days really pursuing things like passport denial of revocation, it's important to make sure that you file, and it's important that if you qualify for FEIE, foreign earned income exclusion, that you include the income and then you include the exclusion form. For some taxpayers who live in a foreign country that's a treaty country, they may be able to make a treaty election to be treated as a non-resident for tax purposes, which would mean they only file a Form 1040-NR and report their U.S. sourced income, not a Form 1040 to report their worldwide income. Some international reporting forms are still required. Some taxpayers will claim they don't have to file it. It's up in the air. The proposed 3520 regulations make it sound like it may not be necessary. In a recent FBAR case, ROS Day, the court said it's not required if you qualified for a treaty election as a non-resident. IRS disputes that. Their publication 5569 is very clear that the FBAR is still required even if you make the treaty election and qualify as a non-resident. In fact, that's one of the examples that they use. And of course, the taxpayer could formally renounce or terminate their U.S. status, but there's lots of issues with that. Is there exit tax? Is it a covered expatriate? Will they be giving gifts to U.S. persons in the future? Not something to just kind of do off the cuff. It's something you really want to think about. For taxpayers who are out of compliance, there are various programs they can use to get into compliance. If you're willful, your only option is really VDP if you're going to do anything, the Voluntary Disclosure Program. If you're non-willful, there's lots of different options available. The best one for expats is the streamlined foreign offshore procedures. Why? Because even if you didn't file original returns, you can do so, and there's no penalty at all. All the penalties waived. We have a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.